Ajay Srivastava joining us this morning, MD Dimension Corporate Finance Services. Ajay, we always love our conversations with you and thank you so much
Good morning.
for joining in today. Very good morning to you. Chalo, let's start with what is kya hal chal chal raha hai, because really difficult to figure out what's happening in the markets right now. Domestically, we're looking fine, but what Trump will do next has become, I think, a global obsession.
Oh, yes. That man has just changed the world, the way the world looks at. And I think he's the first non-politician to come in. And it's been a great refreshing because he is tearing up the rule book run by the politicians or professional politicians who do nothing else. And I think we have a fair share in India as well.
Are you a
Who do
Trump
nothing else
fan?
but play
Ajay,
politics. So
are you
but
a
he's a
Trump
great
fan?
relief to the market.
Are you a Trump fan? And a fan of
Oh, my
everything
God.
he's
Oh,
been
my
doing?
God. Yes. No, not a fan, but I think it's a great become the president, gets persecuted, comes back again, shows resilience. At age 79, 78, imagine electioneering in America, traveling to all the sleeping in a new hotel every day. It takes you courage and resilience and perseverance. I think it's impressive, very impressive performance. And everybody has frailties, everybody has problems, but I think that one thing to note is you need a man of severe guts to say, I'm 2 years on the election run, going to sleep in different hotel rooms at age 77, 78, and still come out fresh, wearing a suit and a tie every day. I think it's the greatest thing. It's the greatest antidote to that cargo pant culture of this world. They're formal, nice. They makes the world go around, and that's what you like about the guy. Come out in the suit and a tie and say, "Okay, here we do, man."
Ajay, what about the policies? I mean, looking good, looking fresh. What about the announcements?
No, I think he's done a great job for his country. He's supposed to look after his country, not the world, and that's the honest fact. He's done a great job for his country that at least put people on notice. You want American markets, you got to be reciprocally alive to that, allow the American goods to come in. And America has lost a lot of market. If you look at cars, America is nowhere in the cars in the world today. If you look at electronics, America is gone in the electronics world today. So, in a way, what we are seeing today is a reflection of what's happened in the last 25 years. You may agree with some of the policies, but the fact is, he's there to look after America, full stop. We don't like it. Nobody likes it because he's hurting us at the end of the day. And I'm an Indian. We are getting hurt as well. So to that extent, you don't like the policies. But the fact is, his job is to look after America. He's doing that for America.
Okay, let's talk about the Indian perspective. And yes, Trump is looking out for America. We're looking out for India, as we should. Now, in a world like that, what happens to the economy? What happens to certain sectors? And what happens to the equities? What do you think is the perspective on Indian equities right now, which seems very bothered with what's happening globally, but it has that underlying strength?
I think, we have developed now a third pocket of equity investors, which is the portfolio managers and AIF. So while we keep reporting mutual fund and FIs, now you see a diverse movement, or even on days when the FIs are selling, even the DIs are not buying, the market is showing resilience. And I think the third big pocket, which is coming up, the portfolio managers and AIF, is becoming a huge pillar for investment in the country, and money is still pouring in. So on a demand supply front, I think demand for equities is going up and will further go up if RBI pursues the path of interest rate reduction, because your returns on savings and fixed deposits are going to go down. You're going to look at alternate. So equity markets are resilient. They have got enormous demand potential. They face only one drawback, that you will see in the next 1 to 2 years, a lot of allocation going to metals. People have missed out the big metal rally which has taken place, gold and silver. Silver is still coming off for the tracks at this point. So I think you will see a large amount of allocation of capital to those two precious metals. But having said that, I think we have a resilient market. Just remember, Tamanna, that our market levels are same exactly at the time when the war broke out between Israel and Iran. That says a lot for the market. It can say also for the stupidity of the market that you're not recognizing the reality. Our valuations are up, oil prices are up. Globally, the markets are a little bit disarray, but our valuations remain flat where they are. So to that extent, you have to take pointers to say, take some profit off the table, just like all the institutional investors are doing, promoters are doing. Retail investors who are not taking profit from some of the stocks they hold, I think will tend to rule them in the next 12 to 18 months.
So no, just to recap that, you're saying retail investors who are not booking profits right now will regret it. How should you look at your portfolio and decide where to lighten the load?
See, people who are in the commodities, for instance, I think they're stuck with the commodities. I think basic non-ferrous, ferrous commodities, it's not moving anywhere in a hurry. Basic stocks, the old favorites used to be the cement stocks and steel stocks and all those things. They're not going to give you a return. So if you're not booked your profit out, you need to do it. A lot of infrastructure stocks, again, have run the rule. Government is not going to spend more money, as we've seen very clearly. It's not willing to move to spend more money in infrastructure. So infrastructure-related theories and stocks are going to suffer. Railways is a great. It flatters once. It's like the flower which blooms once in 2 years. It flatters, then it deceives. It flatters, it deceives. So I think you will be cautious as to where the railway stocks are going. You'll be cautious where the consumers are going. With the P multiples of 100 plus, you got to be incredibly brave to be buying the stocks, and market can remain irrational. I can promise you that much. But the fact is, when you buy a retail stock which is selling, Kirana store selling at P's of 100, I think what are you buying, really speaking? I wonder what growth rate investors factor in when they buy a Kirana store or a bigger Kirana store stock for a P of 125.
Well, one of, okay, Ajay, I don't know if I don't know if you're referring to the same one, but one of the, not Kirana stores, but a large retail format store just reiterated in an annual report that they will grow up revenue from FY23 to FY2032 by 10x. They reiterated that, and a simple back of the envelope math suggested that they therefore are saying that they might grow at 25% CAGR from FY25 to FY32. Now, is that a good enough growth number for, let's say, a trend to trade at the valuations that it is trading at?
Well, the answer is that yes, companies aspire for growth. I think you have to factor into say, are you the believer in that growth story? It has done a tremendous job. I'm not quoting the stock, but just quoting that past is never a feature in the future. The market is changing, the nature is changing, the way people are buying is changing. You used to walk to the department store, you don't do it anymore. You go blink it, right? At the end of the day, it's such a is a Godrej Almira of retailing today. Literally, if everybody wanted to Godrej Almira, today you say, just blink it. At the end of the day, the formats are changing, retail is changing, the margin is not there in the business. So who's going to give them the margin in the business at the end of the day? The competition is intense at this point of time. So yes, you can factor in that it'll happen. The question is, one, growth is never a trajectory. It happens in spurts and busts. Number two is look at the economy, 6.5% growth rate. For you to grow 25%, you got to invest serious amount of capital and grow the stores, and same store sales have to grow for you to make the valuation. Remember this, you're working on a base. Now, existing stores to grow 25% is impossible. It's just impossible, right? So you're going to develop so many more stores. Where are the localities, destinations, purchasing power, etc.? So you should temper it down. Management have a right to expect the moon, but you as an investor needs to know where your money is going to be made. It may still come true, but I think that's not a game where you're going to make that kind of multiples.
Okay, fair call, yeah, and that's a pertinent point. If whether you believe in what the companies can do or may not be able to deliver. Okay, Ajay, so I heard you say that investors who don't take money off the table might review over the next 12 to 18 months, which suggests that on highly valued stocks, you are not that constructive. Therefore, what are you buying? Are you buying value currently in the market? Are you screening your screen for stocks which will be trading at sub 20 times multiples and willing to grow 15, 20%? How are you doing this? And what are those pockets?
Okay, Neeraj, we are not buying anything except the fact we bought everything that PE funds have taken controlling stake in. Okay. That's been our biggest theme in the last 1 year is follow the PE fund, because we know exactly the kind of due diligence they do, the level of follow-up they do, the level of incentive they give to the management, and we know for sure that most PE funds look at structuring a deal for 5 to 7 year takeout, which fits in perfectly for the investors. So you don't need to do your homework. You follow, and best part of India, Neeraj, is that in last couple of deals, you as retail investors, you could even get in at lower price than what the PE funds got in. That's the best part. It just takes away a due diligence mode, just takes away conflict of interest mode, just takes away the fact that man needs to exit in 5 to 7 years with his return, and he's promising his investors 25% dollar rate of return. Remember this, most PE funds are promising between 20 and 25%. So he's going to put his heart out to get your investment return done. So we have followed a simple model, is very unglamorous, very uneducated, totally in North India called Jat Buddhi. He's done his work. Let's just follow him. 9, 10 out of 10, he's going to give the returns. And I can promise you, wherever PE funds are taking controlling stake and you can get in along at the same price, it's the best place to be, irrespective of where the market is.
Ajay, Wondering where you're seeing opportunity right now, or pockets of opportunity right now. What are the cash positions you're holding, if any? And, you know, what are you then finding interesting and waiting for that kind of turn of the cycle?
See, if you look at the data today, which came out, Tamanna, which said that the advanced tax has barely grown by 4.5%. Numbers may change, numbers may go up if 2 more days data comes in. Okay, but tells you the trajectory of the earning in the market at this point of time. And when earnings, kind of go at 4.5% advanced tax, we are in for tough times at the end of the day. Therefore, there is no necessity to buy. You know what he said, what are the themes you want to buy? I don't want to buy anything much at this point. And where do I put the cash? It's a brilliant, we have got a large investment in a power REIT in this country, power transmission REIT. It's given a fantastic return over the 5-7 years. It's given dividend, increasing dividend. Its share price has gone up, unit price has gone up. So you don't have to park your cash away in a saving bank account. There are enough opportunities which give you equal return in the market. And so if you're getting 15-16% returns from these kind of a power transmission REITs, you are not badly off to keep the money there and wait and see what happens to the correction. Let's not forget, Tamanna, look at the stocks just 6 months back when the correction happened. They were 40 to 50% down in less than 3 weeks' time. And now they have climbed back the wall of worry. There will always be a correction. The question is, do you have liquidity to buy into the correction? That's the question you have to answer. Or did you ride the correction holding fully invested? Today is the time to buy other stuff and keep it. If and when it corrects, nobody's saying make it zero. If and when it corrects, you buy it, and you buy things like, let's take hospital themes, you buy things like medical care theme, medical devices theme. Engineering companies in India are extremely good companies, globally competitive. Auto ancillary companies are very good in India, supplying the world. So we have a good amount of, so many new age companies have come up. If you're not bought it, you can buy them into it. So India has no shortage of choices to invest. The question is, have you got your entry price right?
Is the entry price right? Now, I mean, people who can time an entry price, I suppose, are in a different league, Ajay. But right now, from a long-term perspective, say a 3 to 5 year perspective, someone is looking at rebuilding or shoring up a portfolio. What are the key sectors that you're finding most attractive?
As I said, engineering is one of the key sectors in India. We are strong. Nobody can duplicate it. We are even better than China in most cases in engineering. Oh. So that's one sector I can tell you where we are really strong. And aligned to engineering is the auto ancillary segment. We are really strong. Our ecosystem is very good. Nobody can beat us in the world. Let me tell you, nobody can beat us in this world. So auto, two-wheeler auto segment in export market, auto ancillaries, engineering is one segment. We are unbeatable in the global markets. Number 2 is local healthcare, hospitals. You can't recreate a hospital overnight. Whoever has got it is charging you the moon. And anybody who had unfortunately been to a hospital of late knows how much money he pays out compared to 3 years back. So that is one segment which is growing leaps and bounds, safe Indian domestic. Pharma, I know there is a cloud over the pharma in terms of the US, but I think Indian companies are smart. If you look at one Indian company, he just bought a biologics manufacturing facility in US. So they are alert to the fact that things will shift. And contrary to what people imagine, I can tell you, there is huge capacities in America and Europe in biologics manufacturing, in NCE manufacturing. So let's not kid ourselves that, if we don't produce, world will get shortage. There'll be no shortage. There's enough manufacturing capacity, maybe a little expensive. But Indian pharma companies are very smart, number one. Number 2, 50% is domestic and other markets, so it's not that bad. So pharma, healthcare, hospitals is a theme along with engineering you can play with and relax because we are good in those 2 places and competitive in those 2 places. And we don't need tariff support from government in all those places.
Okay, that is important, where we don't need government support, and the tariff view is something that we have to navigate as well. Thank you so much, Ajay Srivastava. Thank you so much for joining us. Always a pleasure. Yeah, you too. You too.